This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
Perceptions of oversupply among oil market participants from increasing OPEC Plus output and uncertainty about the economic impact of tariffs have raised short-term oil price volatility, the U.S. Energy Information Administration said on Tuesday. Oil prices hit a four-year low on Monday after the OPEC Plus agreed to another accelerated oil output hike for June. Reuters later reported the group is planning to further speed output hikes going forward. Still, the EIA said it expects OPEC Plus to keep production below the group's current target path. It forecasts supply from the group to increase by about 200,000 barrels per day this year to 42.9 million barrels of oil per day, up from 42.8 million barrels of oil per day in the EIA's prior forecast.
Oil prices rose on Wednesday, holding slightly above recent four-year lows, as investors focused on U.S.-China trade talks and signs of lower U.S. production. Brent crude futures climbed 73 cents a barrel, or 1.2%, to $62.88 a barrel by 0650 GMT, while U.S. West Texas Intermediate crude was up 81 cents, or 1.4%, at $59.90 a barrel. Both benchmarks plunged to a four-year low recently after OPEC Plus decided to speed up output increases, stoking fears of oversupply at a time when U.S. tariffs have increased concerns about demand.
Moving on to the top news in the energy sector.
The European Commission will next month propose legal measures to phase out the EU's imports of all Russian gas and liquefied natural gas by the end of 2027, it said on Tuesday. The European Union vowed to end its decades-old energy relations with former top gas supplier Russia after Moscow's full-scale invasion of Ukraine in February 2022. The EU executive will present a legal proposal in June to ban remaining Russian gas and liquefied natural gas imports under existing contracts by end 2027, it said in plans published on Tuesday.
Shipments of most widely traded energy products are slowing in sync with the global economy, which has been stunned by the tough new tariffs imposed by U.S. President Donald Trump so far this year. Exports of crude oil, gasoline, diesel and thermal coal all contracted during the January to April window from the same months in 2024, as the economies of importer nations drop down a gear in response to heightened trade uncertainty. The liquefied natural gas and chemicals sectors have registered export volume gains so far this year, but are at risk of a slowdown if the malaise already chilling demand for oil, coal and fuels also cools the power and manufacturing sectors. Next, we have the top news in metal markets. Prices of most metals in London were down on Wednesday as investors caution about the outcome of an upcoming meeting between key U.S. and Chinese trade officials outweighed optimism about Beijing's economic stimulus efforts. Benchmark copper on the London Metal Exchange declined 0.6% to $9,477.50 a metric ton as of 0712 GMT. The planned meeting between U.S. and Chinese officials this weekend in Switzerland comes after months of escalating tensions that pushed trade duties between the world's two largest economies well beyond 100%.
China's central bank added gold to its reserves in April for the sixth straight month, official data from the People's Bank of China, PBOC, showed on Wednesday. Gold, traditionally seen as a refuge from political and economic uncertainty, scaled an all-time high of $3,500.05 per ounce last month, boosted by tariff war fears and strong demand in China and elsewhere. Bullion is up 29% so far this year. Despite high gold prices, China's gold reserves rose to 73.77 million fine troy ounces at the end of April from 73.7 million ounces at the end of March.
We will now look at the top news in the agricultural sector.
Malaysian palm oil futures extended losses on Wednesday, continuing their decline for the seventh straight session, on worries about an increase in palm production and lackluster demand from major consumer countries. The benchmark palm oil contract for July delivery on the Bursa Malaysia Derivatives Exchange lost 38 ringgit, or 1%, to 3,754 ringgit, $886.63, a metric ton by the midday break. With increasing palm production, the U.S. government policies for biofuels and lackluster demand from major consuming countries, palm prices have taken a fast dip, said Sandeep Singh, director of the Farm Trade, a Kuala Lumpur-based consulting and trading company.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.